Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Nike Inc., trading under the ticker NKE.
Right.
Nike is executing a foundational corporate transition that prioritizes a return to a wholesale-led, sport-obsessed operating model, intentionally de-emphasizing direct-to-consumer digital channels to restore premium brand health. However, this strategic pivot creates a structural tension, temporarily depressing top-line revenue growth while the company navigates a challenging, price-sensitive global macro environment.
Yeah, it is a massive, massive shift.
It really is. And, usually when you and I look at these multi-billion-dollar earnings reports, there's a comforting expectation of precision.
Right, exactly. Like looking at an X-ray.
Exactly like an X-ray.
Yeah.
You check the top-line revenue, you observe the bottom-line profit, and the math just cleanly dictates the reality of the business. I mean, you sold the shoes, you made the money, or you didn't.
But that is not what we have here.
Not at all.
Yeah.
Because when you step into the world of multi-year corporate turnarounds,
Yeah.
especially in the middle of these severe macroeconomic shifts we are seeing, that pristine X-ray machine is just broken.
It's completely shattered.
Yeah, we're looking at a financial and diagnostic landscape today that is incredibly murky. It's like looking into a funhouse mirror, where the biggest, most impressive numbers are actually the ones distorting the reality the most.
It is the absolute definition of diagnostic muddy waters. I mean, if you don't know exactly what you're looking for, or if you just, skim the headline numbers that flash across the financial news network.
Which so many people do.
Right, exactly. If you do that, you are going to walk away with a completely inverted understanding of this company's underlying health. And that brings us to our mission for you, the listener, today.
Yes.
We are going to conduct a strict forensic audit of Nike's massive global transition. This is the Win Now turnaround plan, spearheaded by CEO Elliott Hill. We're going to strip away the accounting illusions, critically evaluate their massive pivot back to wholesale partnerships, and really assess whether this global giant is a structural value play for capital allocators, or if it is trapped in a prolonged, dangerous show-me phase.
I am completely ready for this because, we are digging deep into their Q4 fiscal 2026 earnings, their recent press releases, and really the broader strategic ecosystem surrounding the brand right now.
There is a lot of ground to cover.
There is. So, to start, we have to talk about the headline number that just screamed off the page when this report dropped, the margin expansion.
Oh, yeah, the big one.
Right. So Nike reported that Q4 gross margins expanded by a massive 890 basis points to reach 49.2%.
Which is just a staggering number to see in print.
It is. And for anyone listening who doesn't live in the financial weeds every day, a basis point is just 1/100th of a percentage point.
Right.
So 890 basis points is an 8.9% jump in profitability on the goods they're selling.
In a single quarter.
In a single quarter. Okay, let's unpack this. Because if top-line revenue is generally flat, jumping 8.9% in 90 days sounds less like operational efficiency and more like, finding a winning lottery ticket stuffed inside your winter coat.
And that is a phenomenal way to frame it, honestly, because a lottery ticket is quite literally what occurred here.
Really?
Yeah. When you see a mature, globally saturated $46 billion a year manufacturing and retail company jump 890 basis points in gross margin over a 3-month period, your immediate instinct should be to assume an accounting anomaly.
Right, because you just can't squeeze that much blood from a stone that fast.
Exactly. The physics of global supply chains simply do not allow for that kind of organic improvement in 90 days. You can't renegotiate factory costs and shipping that quickly.
So what actually happened?
Well, when we dissect the math, we can isolate the primary contributor. It was a $986 million recovery from IEEPA tariffs.
IEEPA, okay, the International Emergency Economic Powers Act. We need to explain how a federal law from the 1970s just magically handed Nike $1 billion.
It's a really fascinating piece of legal and financial history intersecting here.
I'll say.
So, IEEPA is a federal law primarily used to allow the president to regulate commerce in response to an unusual and extraordinary threat to the United States. It's usually associated with national security and foreign sanctions.
Right, like blocking trade with hostile nations, stuff like that.
Exactly. However, over the years, its application bled into broader trade and tariff implementations on goods imported into the U.S.
And Nike imports a ton of goods.
A massive volume. So they have been paying these tariffs for years. But what happened is that on February 20, 2026, the U.S. Supreme Court handed down a ruling determining that certain tariffs historically imposed under IEEPA were actually unauthorized.
Wait, so the government had been collecting unauthorized taxes, essentially?
Basically, yeah. And because Nike imports so much product, they realized they had overpaid by a massive amount.
Wow.
Following the ruling, Nike's accountants and legal team deemed the recovery of these previously paid tariffs to be probable.
Oh, I see where this is going.
Right. This allowed them to book a one-time, non-recurring gain of nearly $1 billion. It provided a direct 900 basis point benefit to their gross margin for the quarter.
900 basis points. So that explains the 890 basis point jump almost entirely.
Entirely. Out of that $986 million windfall, they allocated $965 million to the North America segment and $21 million to the Converse subsidiary.
Okay, so when I look at the earnings per share, the EPS of 72 cents for the fourth quarter that supposedly beat analyst estimates, that number is essentially wearing a disguise.
A very heavy disguise.
I mean, it has to be.
Yeah, that 72-cent EPS included a 52-cent direct benefit from this exact tariff recovery.
52 cents out of the 72 cents.
Yes. If you strip away this windfall, this absolute anomaly of a lottery ticket, the underlying adjusted EPS was just 20 cents.
20 cents, wow.
The true core profitability of Nike is actually under intense pressure right now. Without the tariff recovery, the gross margin would have been 40.2%.
Meaning what, year over year?
That is a 10 basis point decline year over year, not an 890 basis point expansion.
Okay, here's where it gets really interesting for you, the listener. If you're trying to allocate capital based on this stock, or even just trying to understand corporate strategy.
Right.
Because you look at the headline and you think, wow, Elliott Hill's turnaround is working miraculously. They are incredibly profitable right now.
Which is exactly what the algorithms and the headline skimmers think.
Exactly. But if you take the time to actually read the footnotes of the 8K, the official report companies have to file with the SEC for major events, they tell a story of severe margin compression.
They absolutely do.
So why is that underlying margin actually shrinking? What is eating away at the core profitability to drop it down to that 20-cent EPS equivalent?
Well, it's the massive operational friction of the Win Now turnaround plan itself.
The cure is hurting the patient.
Exactly. You are looking at persistent severance and operational restructuring costs just bleeding into the balance sheet.
Right.
Recently, Nike moved approximately 8,000 employees into what they're calling vertical sport offense teams.
Wait, 8,000 employees? That is a massive internal reorganization.
It's huge. And to understand this, you have to understand how Nike used to work. Historically, they might have had teams siloed by geography.
Like Nike Europe, Nike Asia, that sort of thing?
Yes, or by broad categories like men's, women's, or kids.
Okay, that makes sense.
But the new model tears all of that down. They are building vertical silos based purely on the sport itself. So you have global basketball, global running, global football.
So someone working in men's Europe suddenly has to re-interview for a job in global basketball.
Essentially, yes. They are literally tearing the operational house down to the studs while they're still trying to live inside it.
That sounds incredibly disruptive.
It is. And it costs a tremendous amount of money in logistics, workflow disruption, and primarily higher wage-related expenses driven by severance packages.
Because a lot of people getting laid off in this shuffle.
Exactly. Those severance costs heavily offset any administrative savings they managed to scrape together this quarter.
It just shows you how easily headline numbers can obscure the operational realities on the ground.
Which is why we do these audits.
Right. If you aren't reading the footnotes, if you aren't stripping out one-time tax and tariff benefits, you are essentially investing blindfolded.
And you will get burned.
You will.
Huh.
It really emphasizes the mission of our investigation today. Because if the margins are organically under pressure, we need to look at how Nike is actually moving physical product to understand the core business.
Which brings us to a massive reversal in their channel strategy.
Yes, the channel strategy. Let's get into that.
This is perhaps the most culturally and financially painful part of their current transition. To grasp it, we have to reconcile a stark divergence in channel performance.
I saw these numbers. They're wild.
Yeah, in Q4, wholesale revenues grew 4%, led by a really robust 10% growth in North America. But conversely, Nike Direct revenues plummeted 7%.
Nike Direct being their own stores and website.
Correct. And within that direct bucket, Nike Digital was down a stunning 12%.
Down 12%. It's like, Nike spent the last 5 years systematically breaking up with its retail partners via text message.
That's a great way to put it.
I mean, they were yanking their premium shoes off the shelves at Foot Locker and independent skate shops to focus exclusively on their own apps and websites.
Yep.
Only to show up on those same retailers' doorsteps today holding a bouquet of flowers and a brand new display rack begging to be let back in.
The bouquet of flowers analogy captures the awkwardness of this pivot perfectly. We have to look back at the prior era under former leadership to really get this.
Right, the John Donahoe era.
Specifically that push led by Donahoe. The mantra was direct-to-consumer, or DTC.
Which every brand was doing during the pandemic.
Every brand. And the financial logic seemed sound at the time, right? Especially during the pandemic boom. The thought was, if you sell directly through the Nike app or Nike-owned flagship stores, you cut out the middleman.
You get to keep that extra 20 or 30% margin that Foot Locker would have taken.
Exactly. You capture the full retail margin, and more importantly, you own 100% of the first-party consumer data.
The emails, the sizing, the shopping habits.
All of it. But they over-indexed. They went too far. And now they are intentionally reversing course because they realized something fundamental about consumer psychology.
Which is?
Being omnipresent in physical retail, in the wholesale channels at the mall where consumers are actually browsing, comparing brands side by side, and discovering new trends, is vital.
Because if I'm on the Nike app, I already know I want Nikes.
Precisely. An app is a destination you only visit when you already know what you want. A wholesale retail space like a Foot Locker or a JD Sports is where you discover what you didn't know you wanted.
Right. You go in for socks and leave with running shoes.
Yeah. So Nike has spent the last year scrambling to refresh over 15,000 wholesale spaces globally in what they're calling a marketplace cleanup.
15,000 spaces. That is a lot of bouquets to hand out to retail managers.
It is a massive apology tour.
But why is the digital side dropping so precipitously? I understand shifting focus to wholesale, but down 12% in a single quarter for an e-commerce juggernaut is like a steep cliff.
Well, it's the painful withdrawal period of a promotional-heavy digital strategy.
Meaning they were discounting too much.
Way too much. During the peak of the DTC push, and especially over the last year when they were drowning in excess post-supply chain crisis inventory, Nike conditioned their digital customers to expect constant discounts.
Oh, I remember that. You'd open the app and there was always a 20% off code.
Always. They trained the consumer to never pay full price. Now, under the Win Now strategy, they are intentionally pulling back on those promotions.
Trying to rip the Band-Aid off.
Yes. They are tightening inventory, sell-in meaning the amount of product they agree to manufacture and push to retailers. In fact, they are intentionally pulling roughly $2 billion worth of classic product from the overall market to artificially restrict supply.
Wait, hold on. $2 billion.
Yeah.
You can't just evaporate $2 billion worth of classic Air Force Ones and Dunks.
You'd be surprised.
How do you actually pull $2 billion in inventory out of the market? Where does it go? Are they just sitting in a massive warehouse in Memphis, racking up climate control and storage fees?
It's a complex logistical puzzle, and you're right, it's expensive. It happens through a few different mechanisms.
Okay, walk me through it.
First, they drastically cut future factory orders from places like Vietnam and Indonesia, stopping the bleeding at the source.
Just telling the factories to stop making the shoes.
Right. But for the inventory already in transit or in the United States, they do hold a significant portion in third-party logistics warehouses.
Which absolutely eats into their working capital.
It does. Second, they quietly divert excess stock into deep discount off-price liquidation channels.
Like Ross or TJ Maxx?
Exactly, or international equivalents. But they often ship them on unmarked pallets so it doesn't degrade the premium brand image at the front of the mall.
Ah, so you don't see a giant Nike truck pulling up to the discount store.
Right, they try to keep it quiet. And finally, some of it is literally ground down and recycled through their Nike Grind sustainability program.
They literally grind up brand new shoes.
If the inventory is that bloated, yes. The core philosophy here is that they are willing to sacrifice immediate, reported top-line revenue to protect full price realization.
They absolutely have to restore the brand's premium halo.
They do. If consumers know they can just wait 3 weeks and get those retro Jordans for 30% off on the SNKRS app, the brand loses its luxury, premium positioning entirely.
It becomes a bargain brand.
Exactly. So Nike is turning off the discount tap. But when you turn off that tap, the immediate result is that revenue falls off a cliff because the discount hunters abandon you.
And this pullback in digital discounts isn't just hurting them in the U.S., right?
Yeah.
It feels like it's completely exposing their vulnerabilities overseas.
It absolutely is.
Because if you turn off the discount tap in a market where you are already losing your cultural cachet, the bottom just falls out.
It accelerates the decline, yeah.
And that is exactly what we're seeing in the forensic audit of their geographic revenue. Let's look at those numbers.
I'll do it.
So North America is the bright spot, up 3%, mostly buoyed by that apology tour to wholesale partners we just talked about.
Right.
But the international pain is severe. Europe, Middle East, and Africa EMEA is down 1%, which is 6% on a currency-neutral basis.
Which is the more important metric here.
Right, meaning if we strip out the fact that the U.S. dollar is flexing against the euro, the actual volume of shoes and apparel being sold dropped significantly.
Exactly. The actual units moved are down.
But the real alarm bell, the thing keeping executives awake at night, is Greater China.
It's a bloodbath there.
It's down 12% on a reported basis and down 17% currency neutral.
Staggering.
And just as a side note, Converse, as a subsidiary, is in absolute freefall, down 32% across all territory.
Converse is a whole other tragedy right now.
But let's focus on that Greater China reset. Because for a decade, China was the undisputed guaranteed growth engine for this company.
It was the golden goose.
So what is happening there? Is it just the Chinese macroeconomic environment slowing down? Because we hear a lot about that in the news.
It is deeply layered. The macroeconomic slowdown in China is real, with youth unemployment and consumer hesitancy playing a role, for sure.
Right.
But the much larger structural issue is deeply competitive and cultural. To understand the 17% volume decline, we have to introduce the Guokao movement.
Guokao, okay.
Yeah, which translates to the national tide or China chic.
China chic, so a preference for local trends.
More than just trends. Historically, for the last 30 years in China, a Western logo like the Nike swoosh or the Adidas stripes automatically commanded a premium price.
It was a status symbol of Western modernization.
Exactly. But that era is definitively over. Today, roughly 80% of Gen Z consumers in China actively prefer domestic brands that reflect national pride and incorporate Chinese aesthetic elements into their design.
Wow, 80%. But I want to push on that. It's easy to write off a 17% drop as just a cultural wave of nationalism, but are these Chinese brands actually competing on product quality? Or are people just buying them to wave the flag?
No, they are absolutely competing on quality and specific localized innovation.
Really? Give me an example of how a domestic brand is actually beating Nike at their own game.
Sure. Take a brand like Anta, for example. Nike designs basketball shoes primarily in Beaverton, Oregon, with the assumption that they will be played on pristine, polished indoor hardwood courts.
Right, like an NBA court.
Right, so they use soft, highly grippy rubber compounds for the soles. But in rural and lower-tier Chinese cities, the vast majority of basketball is played on highly abrasive outdoor concrete courts. To recognize this. And they develop specific cement killer lines of basketball shoes using incredibly dense, durable rubber outsoles that last 10 times longer on concrete than a premium Nike shoe.
That is brilliant.
And they sell them at a localized price point. They didn't just win on nationalism, they solved a hyper-local functional problem that a global monolith ignored.
Because Nike is designing for LeBron James, not the kid playing on concrete in a Tier 3 Chinese city.
Exactly. And the numbers reflect this reality. By the end of 2026, Anta is poised to pass Nike in total Chinese market share for the first time in history.
That is a tectonic shift. I mean, how does Nike even begin to respond to a cultural movement that inherently favors the home team and is out innovating them on the local concrete?
Nike's response is an initiative they call the China for China Product Creation Strategy.
Okay, what does that mean practically?
Instead of designing a shoe in Oregon, manufacturing it in Vietnam, and selling it in Shanghai, they are building deeply localized design and manufacturing pipelines entirely within China for the Chinese consumer.
So a self-contained ecosystem.
Yes. They're trying to speed up the supply chain to react to micro trends on Chinese social media.
Because right now they're just too slow.
Way too slow. But building localized infrastructure takes immense time and capital. Management has openly admitted this initiative won't truly scale and impact the bottom line until holiday 2027.
Holiday 2027. That's practically a lifetime in retail.
It really is.
Yeah.
So for the near term, they are effectively treading water, trying to clean up excess inventory, and attempting to stop the bleeding while they rebuild their cultural relevance over there.
Okay, so China is a massive, multi-year drag. But let's pull back and look at the product mix globally.
Let's do it.
Because this whole sport offense strategy they keep touting in the press releases feels incredibly uneven.
Oh, it is entirely lopsided.
Yeah.
The overarching strategy driving the win now turnaround is the belief that pure performance sports equipment creates a halo effect that elevates the entire brand.
Right.
But right now, the lifestyle side of the business, the shoes you wear to the grocery store or a concert, is drowning.
Right. Sportswear and Jordan streetwear. These are highly discretionary, fashion-driven categories.
Yep.
We're talking about Air Force Ones, Dunk Lows, the everyday fashion sneakers.
Have cash cows.
The cash cows, exactly. And they represent roughly 50% of Nike's total revenue.
Half the business.
Half. And CEO Elliott Hill openly admitted on the earnings call that sell-through in these categories remains severely challenged. They are projecting these categories to be negative for the entire current fiscal year.
Which is terrifying for investors.
Absolutely. I mean, if half your business, the cool lifestyle part, the part that traditionally dictates street culture and music culture, is negative for the year, how do you prevent the entire brand from losing its relevance entirely?
That is the existential question Wall Street analysts are desperately trying to model right now.
So what's the answer?
Well, Nike's answer is an architectural one. You have to rebuild the foundation of the house before you can decorate the living room.
I like that analogy.
The protected moat around Nike isn't streetwear. It never was. It's the pure performance division. That is the structural tailwind powering this entire sport offense. Nike's leadership believes that if you win the gold medals, if you win the World Cup, the kids in the street will eventually want to wear your lifestyle gear again.
I see the logic, but talk to me about that performance mode. Because I look at the running path in my neighborhood, or I look at the shoes people are wearing at the gym, and I don't just see a sea of Nike swooshes anymore. It's incredibly fragmented.
You're absolutely right to point that out. Nike is facing an unprecedented, multi-front competitive threat from agile upstarts like on holding the makers of On Cloud and Hoka.
Oh, Hoka is everywhere.
Everywhere. These brands have captured significant, highly profitable market share in specialized running, trail gear, and perhaps most dangerously, the everyday comfort category that used to belong to Nike Air Max.
People wearing them at the grocery store.
Exactly. But Nike is fighting back fiercely in the pure performance arena. Despite the doom and gloom in lifestyle, their running category has actually posted 5 consecutive quarters of double-digit growth.
Wow, 5 quarters.
Yeah. They reported gaining 5 points of running market share in statement footwear across Western Europe and North America in fiscal 26.
Okay, that's real momentum. And I was looking at the visuals from their Q4 marketing presentations, and there was this incredible, highly produced image of the new Mercurial football cleat soccer, for the Americans listening, literally shattering a pane of glass.
It was a very striking image.
Visually, it was stunning.
Yeah.
It felt like the perfect metaphor for what they're trying to do.
Yeah.
Break through the noise of the upstarts with pure, elite, untouchable performance.
Right.
But I have to apply some skepticism here.
Yeah.
Does a highly technical $250 soccer cleat actually generate enough free cash flow and volume to offset the fact that millions of teenagers aren't buying everyday streetwear anymore? It feels like great PR, but maybe not great math.
Your skepticism is entirely warranted on a unit economics basis. The
Right.
sheer volume of Air Force Ones sold historically just dwarfs the volume of elite soccer cleats.
Yeah.
However, the Mercurial launch serves a dual purpose, revenue and psychological anchoring.
Tell me about the revenue side first.
The revenue isn't negligible. The new Mercurial was the fastest-selling 24-hour launch for cleated footwear in the entire history of Nike Direct. Ever. And looking ahead to the massive global event that is the 2026 FIFA World Cup, Nike noted that by the start of the tournament, they had already sold 2.5 times the number of team kits compared to the same period leading into the 2022 World Cup.
2.5 times.
Okay.
So the demand is there.
It is. They are using computational design, cooling technology, recycled materials. They are aggressively flexing their innovation muscle to remind the world that they are an engineering company, not just a fashion label.
But again, how does a shattered glass soccer cleat or a high-tech marathon shoe fix the core issue? How does it actually trickle down to the kid at the mall who wants a lifestyle shoe?
It's the mechanics of authenticity. Nike firmly believes that cultural relevance in the lifestyle space trickles down exclusively from the pinnacle of elite sport. If the best marathoners in the world are breaking 2 hours in Nike Alpha Flies, and the best football players are scoring in Mercurials because they are technically superior, the brand regains its heat.
So the kid sees the pro athlete winning in Nike and wants to wear Nike to school?
Exactly. The consumer subconscious registers Nike as the gold standard. And critically, they aren't just relying on professionals to do this anymore.
What do you mean?
They are taking this logic down to the grassroots level to aggressively secure the next generation of consumers before they can even build brand loyalty to a competitor like On or Hoka.
You're talking about the NIL programs.
Yes.
The name, image, and likeness revolution in American college sports. This feels like a completely new battlefield for sportswear brands.
It is the new frontier, and Nike is treating it like an absolute arms race.
That's so.
They are aggressively evolving college partnerships from the old model, which was simply supplying uniforms and a check to the university athletic department, to building collaborative, highly personal relationships directly with individual 18 and 19-year-old athletes.
Through that new program they launched.
Right. Their newly established Blue Ribbon Elite program.
I need to unpack the economics of this
Yeah.
because I saw the numbers on the University of South Carolina deal they just signed, and it is staggering.
It's massive.
It's a 10-year partnership, officially launching what they are calling the Nike era on July 1st, 2026. And it's valued at over $70 million.
Yeah.
How does the math on a $70 million college athletic contract actually work? How does it translate to retail sales? And they extended LSU through 2036 as well, right?
They did. And the mechanics of these mega deals are multifaceted. That $70 million isn't just a suitcase of cash handed to the athletic director.
Right.
A massive portion of it is retail product allotments outfitting every single athlete, coach, and staff member across all sports and premium gear.
Which essentially turns the entire athletic department into a walking televised billboard.
Exactly. Then there are millions in cash guarantees and royalty structures based on co-branded apparel sold in bookstores and online. But the truly revolutionary part is how they are leveraging the NIL aspect.
The individual athletes.
Yes. Through these university deals, they are signing individual collegiate stars, like South Carolina's quarterback Lenora Sellers, directly into the Blue Ribbon Elite program.
So what does Lenora Sellers actually get, and what does Nike get in return? How does a college quarterback move the needle for global sneaker sales?
The athlete gets personalized support, exclusive access to unreleased product, content creation tools, and brand collaboration opportunities before they even turn professional.
They basically get treated like an NBA star while they're a sophomore in college.
Pretty much. They become a brand ambassador with a massive, highly engaged regional following.
And what does Nike get?
What Nike gets is localized authenticity. When Lenora Sellers posts on TikTok wearing a specific pair of Nike trainers, he influences tens of thousands of high school athletes in the Southeast who want to emulate him.
Because he's closer to their age than LeBron is?
Exactly. It bridges the gap between grassroots authenticity and global scale. Nike is betting that by locking in these athletes early, they dominate the cultural conversation at the high school and college level, which eventually trickles up to broader streetwear adoption.
So if I'm synthesizing this entire sport offense logic for the listener, you maintain an iron grip on the elite professional space with your exclusive NFL, WNBA, and NBA uniform deals.
Right.
You own the collegiate pipeline by aggressively deploying capital through the Blue Ribbon Elite program. You drive double-digit growth in pure performance running and football through technical innovation.
Check, check, and check.
And management's ultimate overarching bet is that this overwhelming halo of elite performance will eventually reignite the struggling 50% of the business that relies on lifestyle and streetwear.
That is the exact thesis of Elliott Hill's transition. They are treating the lifestyle slump not as a permanent failure of fashion, but as a symptom of straying too far from their athletic roots.
Fix the sports, dominate the field of play, and the streets will inevitably follow.
Exactly. But that mechanism takes time.
Oh, yeah.
It takes quarters, if not years, to filter through consumer psychology, and time is a luxury that Wall Street rarely affords.
Which brings us perfectly to their capital allocation strategy.
The compounder playbook.
Right. Because while management is patiently waiting for the streets to follow the sports, they still have to keep institutional investors from completely abandoning ship.
They have to throw them a bone.
Let's look at the company's structural financial power. Because despite all this top-line stagnation, revenue was entirely flat at $46.4 billion for the year. Nike maintains an absolute fortress of a balance sheet.
Oh, their balance sheet is immaculate.
They are sitting on $9.0 billion in cash and short-term investments.
$9 billion in dry powder gives you the ability to weather almost any storm, provided you deploy it correctly.
And how are they deploying it?
Well, how they are deploying it tells you exactly how they view the relationship with their shareholders during this volatile period. In fiscal 2026, they returned a massive $2.5 billion directly to shareholders.
That is a lot of cash to hand back during a turnaround.
It is. That includes $2.4 billion in dividends, which they actually increased by 5% year over year, and $123 million in strategic share repurchases.
Okay, let's unpack this from an allocator's perspective.
Yeah.
You're the listener. You're managing a portfolio. Why prioritize a growing dividend When your core lifestyle business is negative, your digital channel is dropping 12%, you're pulling $2 billion in inventory, and you're undergoing massive, expensive restructuring. Shouldn't they be hoarding cash?
You would think so, but no, because the dividend acts as a stabilizer.
A stabilizer.
Yes, this is the textbook definition of a compounder playbook in institutional finance. When a company's earnings profile becomes highly volatile and unpredictable, and remember that 72-cent EPS was massively inflated by the tariff windfall, the real operational number was just 20 cents. Management has to offer investors a tangible reason to hold the stock through the pain.
So the dividend is the anchor holding the ship in place.
Exactly. It signals to the market, yes, we are tearing our operational house down to the studs to rebuild it. Yes, top-line growth is going to be ugly for a few quarters, but our underlying cash flow generation is so structurally sound and our moat is so deep that we can afford to pay you a growing yield while you wait for the rebuild to finish.
It transforms the stock from a growth play into a waiting game that pays you to be patient.
It's essentially paying investors a stipend for their patience.
But how much patience will the market actually have when there's so much internal disruption? I mean, we can't ignore the leadership context here.
We certainly cannot.
Just as this complex, high-stakes, win-now turnaround plan is peaking, CFO Matthew Friend is leaving the company after 18 years.
Yeah, that was a shockwave. It's a massive destabilizing shift.
Why is this such a big deal? C-suite turnover happens all the time.
Because what does an 18-year CFO represent? They represent institutional memory. They are the person who navigated the debt markets during the 2008 financial crisis, who managed the supply chain collapse during COVID-19.
They know where the bodies are buried, financially speaking.
Exactly. Elliott Hill acknowledged Friend's immense tenure and promised a seamless transition, but losing a CFO of 18 years during the most critical financial and operational restructuring in the company's modern history inevitably creates an execution vacuum.
The CFO is the architect of the turnaround's math.
Precisely. Losing that architect adds a thick layer of internal uncertainty just when the external market is screaming for predictability.
And the market isn't just demanding predictability from Nike's C-suite, it's demanding it from the global consumer.
Good luck with that.
Right. And frankly, that consumer looks exhausted. There's this pervasive myth out there in retail analysis that sports apparel is inherently recession-proof.
Oh, I hate that myth.
Yeah, that no matter what happens to the economy, people will always find money to buy new running shoes or sign their kids up for soccer. But looking at these numbers, that myth is feeling pretty fragile right now.
It is extremely fragile. We are witnessing the harsh reality of the difference between essential and discretionary spending.
Explain that difference in this context.
During inflationary periods, the demand for premium sneakers becomes highly elastic. You might need shoes, but you don't need a $180 pair of newly released Jordans.
Right, you can wear last year's pair. Or you can buy a $60 pair on sale.
Exactly. Nike leadership openly admitted on the call that the global consumer is under severe compounding pressure.
What kind of pressure?
Well, we are looking at a landscape with persistent, sticky inflation eating away at household budgets. We have evolving, highly punitive tariff policies. Tariffs on imported footwear are expected to hit 15% after July.
15%, that's going to hit the bottom line hard.
And we have ongoing geopolitical instability, particularly the disruptions in the Middle East and the Red Sea shipping lanes, which are directly affecting the supply chain and revenue in the EMEA region.
So the consumer is financially squeezed. Nike is intentionally pulling back $2 billion in inventory to protect their premium status. They are paying severance to 8,000 employees, and they are tearing up their highly profitable digital strategy to go groveling back to wholesale partners.
It sounds bad when you list it all out like that.
It sounds like a perfect, meticulously engineered storm for a contracting top line.
It is. Which brings us to the final verdict and the very real execution risks facing this company. Wall Street is currently treating Nike as the ultimate show-me story.
Show me. Meaning they have to prove it before anyone buys the stock.
Yes, they are entirely out of the benefit of the doubt, and the stock is being punished for it.
Yeah, I was looking at the recent analyst notes following the earnings release. They have absolutely slashed their price targets.
Brutally so.
The median target is sitting somewhere between $50 and $59, but some prominent firms like BNP Paribas have cut their target to as low as $23.
$23 for Nike.
That is brutal for a company that was once the darling of the Dow Jones. They're basically treating the stock as dead money until November 2026.
The November 2026 Investor Day is the definitive catalyst.
Why that day specifically?
Because until management can stand on that stage, present clean financials devoid of tariff windfalls, and prove empirically that the win now turnaround is structurally working and driving organic growth, the market will remain deeply, fundamentally skeptical.
So how should an allocator view this? If you're a listener trying to make sense of this massive transitioning global entity, what's the framework? How do you even model this?
You have to step back and stop viewing Nike purely as a shoe company.
Okay, what are they then?
You have to view them as the world's primary sport-led innovation infrastructure.
Infrastructure.
Yes, think of them as the operating system for global sports.
Oh, like Windows or Mac, but for athletics.
Exactly. They hold exclusive, decade-long, multi-billion-dollar deals with the NFL, the MLB, the NBA, and the WNBA. They provide the literal fabric of the games we watch.
You can't watch a game without seeing the swoosh.
That level of omnipresence creates a foundation of authentic visibility that purely lifestyle brands or even specialized running brands simply cannot replicate. They are woven into the DNA of global athletics.
They're the utility company of professional sports. You can't turn on a television without seeing their logo facilitating the action.
Right.
But even utility companies face risks if the grid is crumbling. So if I'm an allocator looking at this show me story, my immediate fear is the macro environment.
Which is risk number one.
Right. If gas and groceries stay high and youth unemployment in China stays elevated, no one is buying $150 sneakers in Q1, no matter how cool the soccer cleats look.
That is exactly execution risk number one. Persistent, macro-driven top-line contraction.
Are they forecasting that?
They are. Management is already forecasting low to mid single-digit revenue declines for Q1 of fiscal 2027. If the consumer continues to pull back due to inflation or those impending 15% tariffs, that contraction could deepen significantly, erasing the safety of the dividend yield.
And if they're facing tough year-over-year comparisons in places like Europe and North America, combined with the fact that they're intentionally pulling $2 billion in inventory off the market, Q1 and Q2 revenues are going to look awful before they look better.
That is execution risk number two. The potential for a severe headline-grabbing Q1 and Q2 revenue deceleration.
Which could panic the market.
Exactly. Nike warned investors on the call that the upcoming quarters are going to look ugly. The risk is whether the market panics when they see those numbers in print, driving the stock closer to that $23 bear case target.
And the final piece has to be the clock.
The ticking clock on the turnaround.
Yeah. Can they fix the lifestyle and sportswear division before on-holding and Hoka just become the new default for everyday comfort?
Precisely the point, and that is execution risk number three, and perhaps the most critical. It is the risk that the sportswear turnaround fails to scale before the competitive gap narrows even further.
Because that halo effect takes time.
The halo effect of performance sports takes time to trickle down. If they can't reignite the cultural relevance of Jordans and Air Force Ones rapidly, while Hoka and On continue to steal everyday market share, the structural value of the Nike brand permanently degrades from a cultural monolith to just another athletic equipment supplier.
So here is the multi-billion-dollar question you have to weigh as an allocator. Are you willing to hold a stock through a guaranteed Q1 and Q2 contraction, collecting a 5% higher dividend as a stipend, betting on the operational discipline of the sport offense to finally emerge by fiscal year 28? Or is the loss of cultural relevance in China, the pressure on the global consumer, and the unprecedented competitive threat from specialized, agile upstarts simply too steep a mountain for Elliott Hill to climb?
If we connect this to the bigger picture, analyzing this earnings report raises a fascinating, almost philosophical question about the future of the apparel industry itself.
What's that?
Well, we see Nike acting as the absolute immovable infrastructure of pro sports, locking down the NFL, MLB, and NBA for decades, yet simultaneously losing ground in niched lifestyle circles and localized markets.
Right.
As consumer culture becomes hyper-fragmented and hyper-localized, with the Guoqiao movement and Onta's concrete-specific shoes in China being the perfect example, is the era of the monolithic one-size-fits-all global sports brand simply over?
That is a fascinating thought.
Is it even possible for one brand to be everything to everyone in 2030? Or will the future of sports apparel be hopelessly decentralized?
That is the ultimate question facing the industry. If the funhouse mirror of this quarter's earnings report taught us anything, it's that the clean binary math of the past is gone.
Long gone.
We are navigating the muddy waters of a global transition, and you have to read the footnotes to survive it. Thank you for joining us on this deep dive investigation. Risk defined, portfolio protected.